IRA, individual retirement account, is a retirement plan, if you will, where you can contribute $5,500 or up to $5,500 into an account for your retirement. The typical situation is that you would, the traditional IRA is such that you would take a deduction for that $5,500. So going back to my example, 50% tax bracket, I'm going to save half of that, and Uncle Sam is going to kick in the other half, and away I go. I get my $5,500 into my IRA. I put it away. I would give it to a bank, or I would give it to a brokerage firm like a Merrill Lynch or a Charles Schwab or somebody along that line. They would invest it in the way that I told them to invest it. And generally speaking, you're going to be looking at that as a long-term investment. If you pull the money out before you're 59 and a half, you're going to pay a whole bunch of tax on it. So you really don't want to do that. It's really money that you're putting away for the future, and you really want to kind of commit it to the future there. There's another type of IRA that's called a Roth IRA. And a Roth IRA is very similar in nature to a regular IRA, except that with a Roth IRA, you don't take a tax deduction on the front end. So you're paying tax on your $5,500, but you take the money and put it into the Roth IRA. The benefit of the Roth IRA is that you never pay tax on the earnings or the amount that you put in. So typically, we will use Roth IRAs when clients are in a very low tax bracket, because there's not a lot of tax savings. If I'm in a 20% bracket versus a 50% bracket, I'm not saving as much in tax. And remember, I said you're in the lowest tax bracket you're going to be for the rest of your life. So you might want to consider a Roth IRA. We will use it for young people because they have a lot of years ahead of them to compound the earnings on those investments. And those types of earnings are very important, and it's important to start as young as you can. I'll give you a couple of examples. One, if you take and fund, and I'm going to get the numbers wrong, but the concept is the same. If you take and fund that IRA, you start when you're 20 and you stop when you're 30, and you put in let's say $5,000 a year for 10 years, you put in $50,000. When you turn 65, you will have more money putting it in there than the person that started at age 30 and put it in for the next 35 years. Okay, so I put in $5,000 a year for 10 years, that's $50,000. I end up with more money than Don here, who starts when he's 30 and puts $5,000 a year in for the next 35 years, so he puts $175,000 in. Is that right? $175,000. But I end up with more money.